I've heard many promoters complaining about PE's behavior in their companies post-investment. Every promoter wants money after they exhaust all available resources, either for growth or to turn around. But there is no free lunch, and investors are not going to just hand in some high-risk money and pray to God that they get some disproportionate returns. PEs get their money from investors and have a responsibility to invest sensibly, manage the investment, and return the money with profits. So in this video, let's get some understanding if you are ready for a private equity. But before that, let's understand what is private equity. Private equity is an alternative mode of private financing. Basically, a group of investors pool in their money into a fund which needs to be approved by SEBI under the category of alternative investment funds. Ultimately, you need to understand that if the business does well, it increases the value for all the stakeholders. You may think that you know the business well, and I've been running it for a long time, but don't underestimate the knowledge that comes from the PEs. Good PE firms add real value. I've heard promoters saying that their future business value is great and hence want higher valuation and don't want to dilute too much without realizing their dire need for liquidity. We have seen many legal tussles between the promoters and PE funds. Mostly they are about how companies are not honoring their obligation, not transparent, while companies blame private equity funds for putting undue pressure for higher returns and all. You may remember Lilliput Kidswear. They had two foreign PE investors, Bain and TPG, who had invested $86 million. Just 2 weeks after they got approval for IPO in September 11, the PEs got an anonymous call that the revenues of the company have been highly inflated. This call set off a chain of events that their investment got wiped out. A forensic audit was conducted, but its founder Sanjay Narula did not cooperate. Instead, what did he do? He incited workers, protest, threatening text messages, etc. End of story for the company and the investors. Like this, so many stories that are bitter. Not all PE are angels. Some of them put unreasonable clauses in their investment agreement, and some even do micromanaging, which could trigger a series of unpleasant situations. So what's the lesson for the promoters? Understand your specific needs. Be reasonable in valuation expectation. Be ready for a strategy and management change. Be realistic with your business projection. Be prepared to share information transparently. Don't agree for unreasonable terms and don't get bullied. Build resources to buy back. In a nutshell, promoters and their companies must keep these points in mind and be ready before seeking private equity capital. Obviously, they will carry out due diligence, not just on the company, but even on the personal front of the promoters. So be ready. If you are overweight and have comorbidities, don't be surprised if they ask you to go on a diet and exercise regime. They will push you to give aggressive business plans. Evaluate your way of running the business. Suggest changes in the business model, key management personnel, accounting policies, and so on. Famous finance journalist Matt Taibbi said, private equity firms are not necessarily evil by definition. There are many stories of successful turnarounds fueled by private equity, often involving multiple floundering businesses that are rolled into a single entity, eliminating duplicative overhead.